Now, Michael Schumacher, head of macro strategy at Wells Fargo. Mike, great to have you with us. The point here is the sticky word, and I think that's what I would underscore in that Jeffrey Gundlach soundbite. We may have seen the peak, but it's going to stick around. So how does that actually impact the consumer?
Yeah, it's interesting, Melissa. So when you think about this from the Fed standpoint, yes, inflation probably has peaked. No guarantee, pretty likely. But does the Fed really care about inflation 10, 11, 12 months ago? No. The Fed's looking forward and saying, what's the outlook over the next 3 to 6 months? From an inflation standpoint, frankly, not that great month to month. So we, the Fed, have to tighten fairly aggressively. We think that gets going in earnest in a few weeks at the May 4th meeting and continues on in June.
50 seems to be a foregone conclusion by most folks, and so your thoughts on that aren't necessarily a surprise. But what do you see in terms of the next couple of meetings? Do we see, sequential 50 basis point hikes?
The market's priced for that now, Melissa. It's interesting now when you think about the Fed's tools. The Fed will announce a rate hike almost certainly in a couple of weeks. It's also going to announce balance sheet reductions, very, very likely. And lots of people in the market have speculated about this. This has been a popular topic, especially for the last few weeks. So it's a combination of rate hikes and reducing the balance sheet, and it's a pretty potent cocktail. So does it automatically mean the Fed's going to go 50 in May and 50 in June? It's pretty likely. It's not locked in at this point. But I do think a very big rate hike in May, plus the balance sheet reductions, it's almost a given at this point.
Yeah. How do you think we'll see this inflation play out in terms of the consumer and its behavior over the next 6 to 12 months? The New York Fed consumer survey was very interesting. Its one-year look-ahead inflation outlook was 6.5%, which is the highest on record as far back as when the data was collected, Michael. And so I'm wondering, as the longer this is embedded in the consumer mindset, how much more damaging is that instead of just one headline number in any given month?
Yeah, that's the critical point, Melissa. So does this become part of the consumer psyche? Do people with jobs say, gee, I really should negotiate even harder for a raise, or union members push more aggressively? That's the big worry for policymakers at the Fed. So the risk is that if the Fed goes relatively slow, relatively light in terms of rate hikes, that behavior becomes more entrenched. And one thing we've been considering and talking to our economics team about quite a bit is, what is the inflation run rate, let's say, toward the end of this year? If it's still 4% plus, that's pretty dangerous for the Fed. The Fed wants to get that number sub 3 and really to set a pretty good path for inflation at 23. So it's very, very concerned about this becoming really a reinforcing loop. It does not want that at all. That's the very bad scenario for the Fed.
I spoke to you on Fast Money at 5 o'clock, sometime mid-March, end of March timeframe, Michael. And at that time, you said the Fed needs to put some grit in the wheels of business. And it feels like a very different picture at this point. How much grit do you think goes into those wheels? And would you agree, more along with what Christopher Waller said, that, it's going to be a hammer? The impact on the economy could be more like a hammer, as opposed to your grit metaphor.
Let's hope it's grit and it's not a hammer. When you hammer things, they tend to break. So I prefer to stick with the grit metaphor for now, but it's interesting. If you're the Fed, you run the risk of going a little bit slowly and hoping things work out well, or taking the hammer to it and saying, odds are we may overshoot, but at least we'll stem the chance of a really bad problem down the road.
Shepard Smith here. Thanks for watching CNBC on YouTube.